And there are all kinds of things I'm not competent to value. But there are a few that I am competent to value.
Have you ever bought a technology company?
No, I really haven't.
In 30 years of investing, not one?
I haven't understood any of them.
So you haven't ever owned, for example, IBM?
Never owned IBM. Marvelous company. I mean, a sensational company, but I haven't owned IBM.
And so here is this technological revolution going on, and you're not going to be a participant.
Gone right past me.
Is that all right with you?
It's okay with me. I don't have to make money in every game. I mean, I don't know what cocoa beans are going to do. I don't, there are all kinds of things I don't know about, and that may be too bad. But why should I know all about them? I haven't worked that hard on them.
It is no secret that many of the best performing stocks of the last 5, 10, and even 20 years have been technology stocks. Companies such as Facebook, Amazon, Netflix, and Microsoft have grown substantially and are some of the most dominant companies in the world. Owners of these companies' stock have done very well too. Take Amazon, for example. $1,000 invested in Amazon stock shortly after its IPO, when it was trading for around $2 a share, adjusted for splits, would be worth $1,664,000 today. It seems that given these impressive returns and the dominant market positions some technology companies have, the world's greatest investor, Warren Buffett, would be very much attracted to these companies. So why is it that Buffett has completely avoided investing in technology businesses throughout his long and successful investing career? Take a look at this clip of Buffett talking about why he stays away from technology stocks. Make sure to stick around for the whole video because we are going to discuss how these lessons can be used to make you a better investor.
My name is Alan Nagin from Reston, Virginia. I know you like to buy into success stories, but you don't like to buy high tech. And it seems to me, say, in the case of Microsoft, that 10 years from now, they'll be doing software development, just like 10 years from now, Coke will be selling sugared water. And what I'm wondering is why you feel that way when it seems certain companies, high-tech companies, are predictable. And it also seems that in the early 90s, you mentioned you were going to buy a pharmaceutical company, which also seems like high-tech to me. So that's my question.
Yeah, well, I think we said that with the pharmaceutical companies, we wouldn't have known how to pick out which one. We would have thought the industry as a group would do well. From those levels of 1993, you cannot buy high-tech companies at anything like at levels that are commensurate with the levels that the pharmaceutical companies were selling at in 93. I would, and getting to the first part of your question, I think it's much easier to predict the relative strength that Coke will enjoy in the soft drink world than the amount of strength that Microsoft will possess in the software world. That's not to knock Microsoft at all. If I had to bet on anybody, I'd certainly bet on Microsoft, bet heavily if I had to bet, but I don't have to bet. And I don't see that world as clearly as I see the soft drink world. Now, somebody that has a lot of familiarity with software may very well see it that way, and they're entitled to, if it's true they have superior knowledge and they act on it, they're entitled to make money from that superior knowledge. There's nothing wrong with that. I know I don't have that kind of knowledge, and I simply think, and I do think that that if you have a general knowledge of business over decades, that you would regard the industry they're in as less predictable than the soft drink industry. Now, it may also be that even though it's less predictable, that there's a whole lot more money to be made, so that if you're right, that the payoff is much larger. But we are perfectly willing to trade away a big payoff for a certain payoff, and that's the way we're put together. It does not knock the ability of other people to make those decisions. I mean, I asked, first time I met Bill Gates in 1991, I said, if you're going to go away on a desert island for 10 years, you had to put your stock in 2 companies in the high-tech business, which would they be? And he named 2 very good stocks. And if I'd bought both of them, we'd have made a lot more money than we made even buying Coca-Cola. But he also would have said at the same time that if he went away, he'd rather buy Coca-Cola, because he would have felt sure about that happening. it's, different people understand different businesses. And the important thing is to know which ones you do understand and when you're operating within what I call your circle of competence. And the software business is not within my circle of competence, and I don't think it's within Charlie's.
I just want to make something clear. This video isn't about why you shouldn't invest in technology companies. Instead, the goal of this video is to help you better understand the unique aspects of investing in technology-focused companies. In my role as a professional investor for a large investment fund, and in my own personal investing portfolio, I do own some technology-focused stocks that I think will be great investments over time. So with that being said, let's dive further into what Buffett said to better understand why he has stayed away from technology companies throughout his career. 1. Technology companies aren't in what Warren Buffett refers to as his circle of competence. In 1996, Warren Buffett gave the following advice to his investors in the 1996 shareholder letter. What an investor needs is the ability to correctly evaluate selected businesses. Note that word, selected. You don't have to be an expert on every company, or even many. You only have to be able to evaluate companies within your circle of competence. The size of that circle is not very important. Knowing its boundaries, however, is vital. Buffett knows that his advantage is understanding companies in industries that he has a deep knowledge of, and that he has built up over decades, such as consumer packaged goods with his investment in Coca-Cola, or financial services with his investments in American Express and Bank of America. Buffett has a huge advantage over other investors in these certain industries that it wouldn't make sense for him to focus on industries in which other investors have an edge over him. Buffett has been quoted as saying that, quote, predicting the long-term economics of companies that operate in fast-changing industries is simply far beyond our perimeter of our circle of competence. We just stick with what we understand. End quote. This is an important lesson that you can take away from this video. Think about businesses and industries that you truly understand and where your advantage over other investors is. Those types of businesses are your circle of competence, and you likely will be a lot more successful with your investing if you stick to those areas. For example, maybe you manage a restaurant, and as a result of your day job, you thoroughly understand how the restaurant industry works. This could potentially mean you have a better understanding of how companies such as Chipotle, Shake Shack, and Darden restaurants, owners of brands such as Olive Garden, operate. This means that these stocks may very well fall within your circle of competence. Before we get into the second main point, make sure to like this video and subscribe to the channel, because it is my goal to make you a better investor by studying the world's greatest investors. Oh, and it's good for the algorithm. Okay, let's jump back in. 2. Another important thing to understand is that technology companies' moats can be quickly taken away. Look no further than companies such as MySpace, IBM, and BlackBerry, companies that at one time or another enjoyed very strong competitive advantages, only to see that competitive advantage disappear relatively quickly. This is due to the innovation and rapid change inherent in technology companies. The rate of creative destruction has never been faster. The new products and services startups introduce are great for consumers, but can represent an existential crisis to the legacy company. This is why many value investors are cautious and try to avoid companies that are subject to technological obsolescence. Well-respected value investor Monish Pabrai has said, quote, "The durability of technology moats is many times an oxymoron," end quote. If you define a moat as a durable, long-term competitive advantage a company has, you can understand pretty quickly that being highly reliant on technology as part of your business model makes it difficult for your competitive advantage to meet the criteria of durable and long-term, necessary for the competitive advantage to be classified as truly a moat. So now that we better understand the reasoning behind Buffett's decision to avoid most technology companies, I do want to briefly address one potential downside of avoiding technology stocks when investing. It goes without saying that if someone avoids investing in technology stocks completely, they are going to miss out on some companies that turn out to be great investments. Take software companies, for example. Software is an industry where companies tend to be asset light, meaning it doesn't take a lot of cash to run the business. Additionally, and without going into too much detail, great software companies tend to have very high margins and high customer retention, and as a result, can generate a ton of cash for investors. If someone has software companies within their circle of competence, there are potentially many lucrative investments within that area. I am 100% sure that some of the greatest investments of the next decade will be in the software industry. And then just a quick note about recent tech investments in the Berkshire Hathaway stock portfolio. If you have been following the investment portfolio of Berkshire Hathaway, the portfolio Buffett manages, you would notice that some tech positions are in it. These investments have been led by two people Buffett refers to as his lieutenants, Todd Combs and Ted Weschler. These two investors are younger than Buffett and will likely take over managing the investment portfolio once Buffett has moved on from running Berkshire. These two currently manage money for Berkshire Hathaway, and they have been credited with introducing Buffett to the potential of Apple as an investment, and for investing in tech companies such as Snowflake and Amazon. I hope you enjoyed this video. Make sure to check out the other videos on the channel if you want to learn more about investing from some of the greatest investors of all time. Talk to you in the next video.